Thank you everyone for being here tonight. I really appreciate the opportunity to come in and talk about, I'm kind of weird. I love this stuff. This is, finance, anything finance. It's always just been in my blood. So I will probably be a lot more animated than anyone else is on this call about what we're talking about, but I appreciate you being here. And the idea here is that the Washington English Center is wanted to make available to everyone a session in which you learn about different ways in which you can give, right? And this is a topic I talk about with clients all the time, individually, with groups of clients, with I do presentations to federal employees. So this is just kind of, none of this is going to be about how you must give more to Washington English Center. This is all going to be about the tools that are available to you if you are a person who is interested in giving that may not be at first on your mind, okay? So, and a little bit about me. I live up in Brookville, Maryland. I work with Savant Wealth Management. I've been with there for 10 years and a predecessor company another 8 years before that. So this really was, finding my love. I'm a certified financial planner. I've raised my kids here in the DC area, and my wife and I love Washington English Center, all it does. We really think it's one of the most worthwhile causes in the DC area. So glad to be here with you all tonight. Okay, making a difference in philanthropy. I'm going to try and there's slides here that are going to cover a number of topics. I've got a wide range of slides here. This, I will tell you, is something that I've drawn from a presentation I gave to clients in December. So I've whittled down the slides, but there might be some stuff here that you still think is a little extraneous, doesn't apply to you. I'll try and gloss through some of that. Where I want to zero in on tonight is really appreciated securities and donor advised funds. All right, then we'll go a sleeve into qualified charitable distributions, just because I think it's such a powerful tool that nobody's aware of. And we're not all 70.5 yet, but we're all on our way there. So when we get there, I want to make sure that you're aware of a tool available to you at that point that most Americans don't know about, and is a very powerful tool for giving. Okay, so slides are forward. All right, appreciated securities and charitable giving. Everybody thinks about giving cash, right? That's the first thing that comes to mind. That's how you gave charitably when you were young. You wrote a check. You wrote a check to your church. You wrote a check to the museum. You wrote a check to whatever entity you were looking to give to. They asked for money. You write a check. Seems pretty straightforward. You then get a letter at the end of the year from the entity saying, thank you very much for the gift. You use that on your tax return, and you get a tax deduction for US, tax law. Great. However, as you grow older and you have more sizable investment portfolios, a better tool for giving becomes giving appreciated securities. And what I mean by that is just, at its most basic, let's say I have Microsoft stock. I bought it 20 years ago. It's worth a ton more now than it was when I purchased it. I know that when I sell it, I'm going to have to pay taxes, because in the United States, we pay capital gains taxes when we sell a security. What you may not know is that you can take that security and you can give it to a charity. Now, how does that help you? Well, it's a double tax benefit. You still get the charitable benefit that you would have gotten otherwise. You can use on your tax return, but you also avoided a capital gains tax that otherwise you would have paid. So it's a double layer of tax benefit. And sometimes people will say, well, but I love my Microsoft. I don't want to get rid of my Microsoft. I want to hold it forever. That's great. In this imaginary case where I'm saying I'm going to give $10,000 of Microsoft to a charity, I can take that $10,000 of cash that I would have given, buy more Microsoft, and use $10,000 of my Microsoft to give to the charity. I haven't changed my position in Microsoft at all, but I have changed what's called my cost basis, the amount I paid for the Microsoft that I hold. Okay, so I've reset my cost basis higher, meaning at some point, if I decide to sell my Microsoft for my purposes, I will pay less taxes than I would have otherwise. All right. So giving via appreciated securities is as simple as designating a portion of your investment account, typically the portion that is at the highest appreciation of anything that you hold. That's what's going to benefit you the most. And you don't need to think, oh, well, then I need to wait a certain number of days. Because sometimes you've heard about, well, don't you need to, if you're making a change in stock, don't I need to wait a certain number? That's called the wash sale rule. And that has to do with when you're buying and selling stock. This is not an exercise of buying and selling stock. So the same day that you donate to the charity, you may repurchase shares of Microsoft. You're not running afoul of any US tax laws. You're in fact doing everything that the law allows you to do and just taking best advantage of it, okay? So it can be a stock, it can be a bond, it can be a mutual fund, it can be an ETF. It can actually, some charities are not interested in this, but it could be a work of art. It could be a piano. There's really no limit from the US law's perspective of what you can donate. That's why, you know, years ago, you heard all that car ads, right? Cars for kids, the jingle that'll never get out of any of our, thank you, I know, I just put it back.
Just put it back.
But that you donate a car, the reason for doing that is any asset may be donated, right? So that when we give appreciated securities, looks like somebody wants to join here. When we give appreciated securities, we're just taking an asset and giving to the charity in lieu of cash. Most charities, a lot of times people come to me and they say, yeah, I'm giving to a small charity and I'm sure they don't have an investment account. You'd be surprised. Most charities will have a brokerage account open, and Washington English Center definitely is one of those entities, to receive those securities. Now, then you kind of think, well, wait, I don't want to put the tax burden onto some other entity. I avoided taxes, but no, a nonprofit does not have to pay capital gains taxes. So they may immediately sell the security, receive all the money that you would have given, but they don't have to pay any taxes on it. All right, so all you've done is taken something that was already a great gift to give to a charity, and you've made it better because the charity got the same thing and you got to avoid extra tax. Now I will pause there and just see, are there questions about that? Because that's where, this is our baseline. We're now going to kind of go into level 200. And if you want to make sure first that we all got 101 down.
I have a question.
Yes.
So it's stock, it's not necessarily individual stock, it could be mutual fund.
That's right. That's right. It's shares of anything that you would like to give.
Okay.
Now, the one thing that is, it's going to be a taxable brokerage account where this is impacted by. We're not going to do this from an IRA. We're not going to do this from a 401k. That's not going to help us because every time we take a dollar out of one of those investments, we pay income taxes on that, and we can't avoid that. Except a way that I'll tell you at the end. Stay till the end. But this is really a taxable brokerage account where we have purchased securities and we're holding them, and they have appreciated since we purchased them. Okay. All right. Any other questions from those online? Okay. Now enter in the donor advised fund. So I'm going to add an interim step. We'll start right where we were. I want to give appreciated securities. I want to give them to a charity. I'm just going to add an interim step where we're giving to a donor advised fund, and then the donor advised fund gives to the charity. It's the same operation, $10,000 in Microsoft stock, but now it's going into a donor advised fund, and then there's going to be a gift from a donor advised fund to a charity. Why a donor advised fund? A donor advised fund, they've been set up by Fidelity and Schwab, are the two 800-pound gorillas. There's another that will accept a wider range of securities called American Endowment Foundation. These are themselves 501c3s, okay? When they set up this entity, it is its own 501c3. So that means that any amount that you give into it is like giving to a charity. However, think of it like a parking lot for giving, because you're putting the money into the donor advised fund, and then later on you make grants from the donor advised fund to the individual charities that you want to give to. So at its most basic level, let's just stay with the example I'm on. I have $10,000 of Microsoft I want to give. I don't want to give it to one charity. I want to give it to 10 different charities. Well, I could give $1,000 of appreciated stock to 10 different brokerage accounts of charities, or I can give a one-time $10,000 of Microsoft stock into the donor advised fund. It's immediately sold. I now have $10,000 of cash, and I may use it to give to all the charities that I want to. So it makes things administratively easier for me to do my giving for the year. And it could be that I wanted to give $200 to a charity, but it didn't seem practical to use. You're right, it wasn't a practical probably to use appreciated stock for that. But since I've given into the donor advised fund, they have no problem with doing a $200 grant to a charity from that itself. Now, 501c3s love and hate donor advised funds. Why? Because it's great that you can put money into a holding account and then that goes to charity. The problem in the United States is that we are amassing an amazing amount of money inside of these parking lots for charity that has not yet gotten to charity. So the thing that I encourage my clients and everyone I'm giving these presentations to is this should still be something that you are intending to give, right? You don't have to. You get the tax deduction the year that you made the contribution to the fund, okay? It does not matter when you give to the charity. So in 2025, May 1st, I give $10,000 of Microsoft stock. I get a $10,000 tax deduction for charity. I don't give anything until January 1st of 2027. When I make that gift, I don't get any additional benefit on my tax return. I already got the gift when I put the money into the donor advised fund. Okay. However, it made things easy to get all the money that I'm intending to give into the fund at once and then make my gifts after that. Now, let's get a little bit more sophisticated with how we're using a donor advised fund. Why else would I want to use a donor advised fund beyond just simplifying my planned giving? It's also so that I can bunch my charitable gifts. So here is a table that's going to show me, all right, I have I can itemize my deductions. Oh, there's a question? Good.
Are there any minimum distribution requirements?
Great question. Are there minimum distribution requirements on a donor advised fund? Every donor advised fund has its own minimum giving requirements, but like I will say, it's probably $50 every 5 years. It's de minimis. It's nothing like if you set up a private foundation, you have to give out 5% of it every year, or it doesn't run. It can't work, right? And so a lot of people's giving, instead of setting up this complex foundation, they've now decided to actually make very large gifts into donor advised funds because there is no required giving amount every year. And now you can administer a large amount for giving to institutions over time in one place without having to go to the complexity of having an attorney, draft documents for your foundation, have annual statements, file taxes, all of that administrative mess. You just give it to the donor advised fund and hand that off to someone else to handle. Okay, yeah.
When you're starting one of these funds, is there a set amount of money?
A minimum to go in at the beginning? Yeah, they'll have each their different amounts, but it's not going to be large. I mean, like $500 and you can open up a donor advised fund typically. It's not a large amount that has to go in. Yes?
How difficult is it to actually set one up with Fidelity or Schwab?
How difficult is it to set up one at Fidelity Schwab? It's really not hard. You go online, you go just look, like, type in Schwab Donor Advised Fund. It will take you to schwabcharitable.org. You'll go there, you'll open up the account, you can fund it, within days. It's real. Now, I will tell you, it's days if you do it now. Don't do it in December. Just don't even, I've done my best. I'm fighting a Don Quixote war against charitable giving in December. And I know that everybody it's the time of year where we feel like giving. And this is, yes, that it is an administrative nightmare. I will tell you, Schwab and Fidelity get completely overwhelmed. Thank you very much. By the amount of charitable giving done in that month, the number of funds attempted to be set up, the number of gifts attempted to be made from that fund. And the other problem you run into is that potentially you try and give securities in, it doesn't work for some reason, and the tax year has passed. And I've had clients have that happen to them. They'll come to me, December 20th, can you set up a fund for me? I cannot. Schwab has already told me, no, you can't do that. They say, send them to online and have them do it themselves. It's very easy, right? Not very easy. Sometimes you think you've gifted the amount, you haven't, it goes bad. You don't realize it until January 2nd and you just missed out on your charitable giving for the year. Shift your giving to November, October, September, if you will, and there's no issues at all. It's a ghost town. Everything's fine. There's plenty of space, plenty of people to help you. Okay? All right. So the reason I would, other than avoiding capital gains taxes and doing for simplicity, I'm now talking about, well, I can bunch my charitable giving into a year to take advantage of more itemized deduction than I would qualify for otherwise. So here we've got a sample 5-year scenario. As of the Tax Cuts and Jobs Act of 2017, we reduced to just 4 categories of itemized deductions. We've got charitable, we've got state, property, mortgage interest. There's one missing from that. Oh, medical. It should, state and property is really one category. It's the SALT deduction, right? State and local tax. And that is limited, that one right there is limited to $10,000 total. You can take no more than $10,000 from state and property taxes in total, in aggregate. So if you've gotten to the point that you don't have very much mortgage anymore, now you're not getting much mortgage interest help on your itemized deductions. And let's say you're getting $10,000 of state and local tax, and you're getting $5,000 of mortgage deduction because you've got a little bit of a mortgage left. Now that's $15,000. If you're married filing joint, your threshold is more like $30,000, until at which point your giving becomes greater than the standard deduction of $30,000 or so, give or take. Okay. I can give $15,000 to charity and have it not help me one whit on my tax return. And I've had clients tell me, no. My charitable gifts are helping me every year. I am sending the letters to my accountant and I am getting help on my tax return by my charitable gifts. And I say, will you please show me your Schedule A? And they show me their Schedule A and it has $25,000 on it. And then it has the $30,000 standard deduction below it. You see 30,000 carried over to the 1040, and they did not get any help from their charitable giving on their tax return. They just didn't get high enough to overcome the threshold of the standard deduction limit. This is very new. It's only the last 8 years this has been the case. The standard deduction used to be very low. It was an easy bar to cross over, especially because state and local taxes were fully deductible. So all of us here in the DC area got a massive state and local tax deduction benefit, and every dollar we gave to charity helped us. That is not true anymore. Very high standard deduction, very hard to get at times over that threshold, okay? So what we do instead to try and get over that is we bunch our charitable giving into a single tax year. How are we able to do that? We're able to do that with the donor advised fund. So now what I say is, well, I know over the next 5 years, 2 years, 3 years, 4 years, whatever you want to do, let's say 5 years of I want to do all this giving, but if I do it in every year, I'll never get a tax deduction. We'll do it all in the current year, give that large amount into the donor advised fund now, give out from the donor advised fund over the next 5 years. And because you gave so much charitably in this year, you moved from where none of your charitable giving was helping to potentially 3/4 of half to 3/4 more of your charitable gifts are now helping you. You're getting a tax deduction for them. Okay. Typically, I tell clients to bunch this in a year where they have unusually high income. If they're selling a business, great. If they have an unusual bonus from sales bonuses, what have you, you get a very large income spike. Time all your charitable deductions into that year, and the donor advised fund is the perfect vehicle to do that. Now it's about 0.4% annual cost on balances in the donor advised fund assessed by Schwab, Fidelity, whatever entity is running it. That covers their administrative costs in running that fund, right? So that is your cost that you're paying. Yes.
And say you put this large amount in your donor advised fund. Is that invested and will it grow?
Great question. So what happens to the money once I put it inside the donor advised fund? Okay, once I put it into the fund, American Endowment Foundation will allow you to continue to hold what you held. So I just did this. I had a client who was working for Amazon last year. He's a high enough position that he has a holding requirement for his Amazon stock. I could not use Fidelity or Schwab for that, because if it went into Fidelity or Schwab, that stock would be sold upon entry. American Endowment Foundation, I can reach out to them and I say this individual cannot sell this stock. They need to continue to hold it, but they want the charitable gift in this year. They will accept the stock and continue to hold the stock so that no stock is sold. So you got to look at what your need is. If you want to continue to hold what you held, you can do that. If you want to convert it to cash, any of those entities can do that. The hybrid is, well, what if I want to keep trying to grow it inside of the fund? And the way that you would do that, well, there's multiple ways. One, you can work with an investment advisor, right? Fidelity will play with, I mean, we can help clients at $250,000 or more. We can help them manage and build out an allocation that will have standard pools of investments that you can use. So if you want it all in the S&P 500, you can generally find a stock pool in there that kind of gets what the S&P 500 would get. And now you've diversified what was a concentrated holding, and it can still grow. I love this. If you look at the research into this, this is a way that a donor advised fund really comes out ahead of a private foundation. And the reason is a private foundation has that 5% annual giving requirement. It has to make every year. That means you can never invest it aggressively. If you're going to have to pay 5% out of it per year, you shouldn't put more than 60% of it in stocks, because there's going to be years where stocks are down and you still need to make your gifts. And so you need to have that defensive moat to be able to absorb the planned giving. If you want to do a donor advised fund that has no planned giving requirement, if you're comfortable going years without making gifts, you can put that fund all in stock. It can grow much more over time. There will be down years, but over time, you'll actually be able to grow your giving probably exponentially, because you're able to invest it more aggressively inside that donor advised fund than you could use in a private foundation. If they do institute, I do think at some point we're going to have a giving requirement from a donor advised fund. And that advice that I've just given would change if that were to happen. There's just too much money sitting in donor advised funds and too many nonprofits saying, we'd really like to have access to those funds. Can you please put some rule on how much they have to give out each year? But for now, no giving requirement. I see a hand raised. You can feel free to unmute and ask your question.
Yes. Hi. First of all, thanks for this. This is really helpful. So you said that the 501c3s love and hate the donor advised funds. And you've sort of described here why they might hate it, but why do they love it? And they actually must, because I've gotten emails saying, encouraging me to use donor advised funds, or saying, I can't remember the exact number, like your contribution will be worth 5 times as much if it's through a donor advised fund or something like that.
That's interesting. I mean, the reason why I would see that a nonprofit would encourage use of a donor advised fund is for the exact reason that I posted here. It's that you can encourage more giving when you are back to getting tax benefits for your giving. And if they're saying you're going to get, I don't know that the charity will get 5 times the benefit. You'll certainly get potentially a much larger tax benefit by using it if you are well below the standard deduction threshold. If you're already above, I mean, I sit down with many clients who have gotten a new mortgage in retirement. They're already, $20,000 in mortgage interest, $10,000 in state and local taxes. It becomes much more half dozen, 6 of the other, right? You're already getting benefit for your charitable giving. You don't necessarily need to use the donor advised fund to bunch. But for most people in their 60s, we've gotten to a point where we're below that standard deduction threshold. So that's the real reason you would want to. The charity, not so much. I'd say they're neutral probably. But I do think that it does in this country encourage a lot more giving than there would be otherwise, because we've kind of reinvigorated this idea of how can we get tax deductions for it to line up with our giving, right? Another example, I said you might want to do a donor advised fund the year you sell a business. If you are an owner of the business, there may be a way that you can gift a portion of your business ownership into the donor advised fund prior to the sale of your business. So you can actually reduce the capital gains tax bill you would have when you sell the business, because a portion of your ownership was no longer held by you, is held by the fund. That is complex. Now we're level 400 stuff. And so if you have questions about that, I'm happy to talk on a one-on-one level. I'm not going to go into depth on that here. But it does, that's a perfect example where somebody who might not otherwise have thought of doing as much charitable giving might do more, because it not only saves them income taxes, it saves them capital gains taxes. Okay.
Thank you.
Sure.
So Joel, I just have a question
Sure.
for you that follows on Dan's question. Why do you think, if nonprofits are reaching out to donors with messages of giving through a donor advised fund, why are people sitting on it?
Why are they not using the
Yeah.
fund? What are they?
Because they put it in there because they have a need and then they kind of forget that they've got it, or
This is surprising. You're saying, why does money not get spent out of that fund more? Because they've already gotten their tax deduction.
Yeah,
What's
yeah.
the-
what's,
It's paralysis of making a decision.
Okay.
I mean, I will tell you, I mean, I've got clients with $3 million in a donor advised fund, and every year I say, who are we going to give to this year? Let's do and they say, oh, let's just decide that next year. I don't really know. I'm not sure. That's the problem. It's engaging people in.
Philip knows the answer to that. Sorry.
It's engaging people in the process of giving, right? And this is, I'll do a little pause here. This is not going to be one of the slides, but it's one of the things that I think is really important. Oftentimes I'll sit down with a couple or an individual and I'll look at their estate plan and I'll see that there are charitable entities getting funds after their death, which is great, wonderful. I love it. However, how much more powerful to give during your lifetime and see the power of your gift to that charity and get tax help that you are not going to get if you give after your death. There's no income taxes due at that point. So we can take what was a great intent to be done post-mortem and turn it into something that is helping you on your taxes now, and you are seeing the benefit of the good that you are doing by the giving you're making, right? So I'm a huge advocate. I am not one of the ones trying to grow donor advised fund balances. I completely agree with you, John. The idea is, if you've already gotten the charitable deduction, what are you waiting for? You know, plant the seeds, let it do good in the world. Okay, don't just let it accumulate in a silo. It's not doing anybody any good there.
Joel, could you say a word about restrictions on the charitable gifts, that you can't get anything?
Great, Margot, thank you. So when it's gone into a donor advised fund, what you need to know is that it's no longer your money. Okay, it now is the 501c3's money, so it belongs to the Schwab charitable fund, for example, right? So you are making a grant from that fund to a charity. They renew their list of 501c3s, I think it's monthly. So as new 501c3s are created, they see it, they add it into their system, it becomes an acceptable place to give to. If you have a 501c3 that you've gone to Schwab and Schwab has said, no, we're not going to give to that one. Excuse me, generally what you do is just go back to that charity and say, hey, you're not on Schwab's list yet. Here's the number for somebody at Schwab. Can you please reach out to them? And generally there's an IRS form that they have as a 501c3 that not provided to Schwab. They can provide it to Schwab. They're at it, no problem. But you cannot give from a donor because it's already been a charitable deduction. You can't give funds for something where you get a benefit. Right, so if this is a dinner where the value of the dinner was $60 and you're trying to give $1,000 through donor advised fund, the $60 dinner disqualifies the donor advised fund. What you'll want to do instead is you'll want to go to the charity, say, I'd like to pay out of pocket for the dinner, and I'd like to then make a gift to your donor advised fund that's not connected to the dinner, right? So it's the same kind of thing for a pledge. Donor advised funds may not be used for pledges. So and that means like if you've got a capital campaign for your church, they need a new air conditioning unit, you pledge, $50,000 over the next 5 years. Don't tell Schwab that that's a pledge. Because as soon as Schwab hears pledge, they'll say, no, we can't do pledges. Why? Because you're locking in another entity for making gifts. It's not you anymore, it's them, and they, by policy, are not going to commit to giving that money every year. Now, what are you gonna do instead? You're gonna go to Schwab this year and say, please give my church $10,000. And you're gonna go to Schwab again next year and say, please give my church $10,000. You're accomplishing the same thing. You just didn't call it a pledge. Never say pledge to the donor advised fund. They don't like that. Okay? But yeah, as long as there's no exchange for value, and as long as it's not a pledge, and as long as it's a registered 501c3, it's gonna be fine. Now, sometimes you want to do your giving internationally. You need to make sure that whoever you're giving to has a 501c3 within the United States. They can be an international organization that sets up a 501c3 in the United States to receive gifts. And then you can use your donor advised fund for that. Okay. Okay. So not too many other questions about donor advised fund. I am going to pivot off of that. I've talked about appreciated securities. I've talked about donor advised funds. I've got a couple other little topics here, but I want to make sure, I know that was kind of the heart of what everybody wanted to hear about. So if you have questions about the administration of a donor advised fund, or what you can or can't give to it, speak now. I'm happy to answer any questions. Yes.
I have one more question, which is, suppose you put money in a donor advised fund and you pass away, what happens?
Oh, great question. Okay, you put money in a donor advised fund. First of all, you may own it only by yourself. You may own it with another person. You can have multiple, and you can name it whatever you want. Most people will name it something like the Kundick Family Giving Fund or something like that, right? Whatever you want to name it is fine. But behind the scenes, you're either a solo owner or your spouse is a co-owner with you. Okay. It's just like any joint account. So one spouse dies, the other spouse is still living. That spouse can continue giving from it as they gave before. But at the second death, there's two routes it can go. You can either name a successor grantor. Let's just say you name your child as your successor grantor, and then they make decisions from that point forward on who to give to. Or you name as one or more charities as the recipients of those funds if you die. And so it's kind of saying either the trustee route or the beneficiary route, right? So you have a successor trustee, one of your children, one of your friends, whoever you want it to be, or just fixed beneficiaries like any retirement account where you said, I want it to go to these entities if I die. Okay, yes?
And so those entities have to be named.
Yes.
Beginning when you're setting up your.
Oh, well, they have to be named when you set it up, but they may be changed anytime you want. It's revocable decisions. So you can change your mind whenever you want on that front. Good.
Oh, go ahead.
Go ahead, Margo.
No, just another question. Say you set up your DAF, over a number of years, you spend it down. Can you top it off and add more
question.
money?
Yeah, you can make multiple contributions into a donor advised fund, even within the tax year. There is no limitation to how many times you can put money in, and there's no limitation to the number of times you can take money out. They place no restrictions on that. Okay, so this is something, it's designed to be a living entity, certainly. Every year you can choose to give amounts in.
And then whatever you put in, you get do you get a tax
Yes,
benefit?
the amount that you donate into the donor advised fund, you will get as a charitable deduction on your taxes that year. You'll get a letter from that entity being your charitable giving letter. So sometimes, I mean, if you get a letter from your 501c3 that you've made a grant from your donor advised fund for, keep that in a nice, oh, isn't that a wonderful folder? I appreciate them doing it, but don't keep it in your tax folder. Because it'll confuse things. You gave from a donor advised fund, that's not a charitable gift for you this year. But yes, any money that you put into it, the fund, the donor advised fund will send you a letter at the end notifying you what your gift was. And the way I believe it works is that if you're giving a stock, then it's the average of the high-low price on the day that you gave the stock into the fund. That's officially what will be the value of what you gave to that charity, because it is a floating price. And so a lot of times somebody will say, well, I want to give $5,000, right, to Washington English Center. Then we're getting out of the fund. I say, well, great, let's give 300 shares of this security, and that's going to come out to like $5,110, right? Or at least that's what it is right now when I'm making the gift. Is if it drops between now and when the gift actually transfers, it's going to change the actual amount. It's not near as So sometimes I know there's, some of my clients say, well, no, I want to give $5,000. And I say, all right, well, great. What we're going to do is we're going to do $4,900 in stock. We're going to let that settle. We're going to know what that gift was because we'll be able to see it. And then you can give cash for the other $100 that you get right to $5,000. Okay. The other thing I will mention about donor advised funds that is one of my favorite uses for them. It's not, it's just, we straight into territory that is not about tax savings, okay? But it's that it can be a tool for bringing a family together. All right, you give money into that donor advised fund, and then you talk with your children every year about who you want to give to. And it becomes a family exercise. So I have clients who, what we do is they sold a business and they put $250,000 in a fund. And they know they want to give $10,000 a year from that, but they have 3 children. So mom and dad identify $4,000 of gifts they want to make. Each of the kids identifies $2,000 of gifts they want to make. They get together at some point during the year, talk about these charities that they're interested in giving to, learn more about each other, right? And their charitable interest and intent. And as an added benefit for families that are trying to get their children used to having wealth someday, it's a very safe sandbox. You could just show them the investment statement for the donor advised fund and say, see, this is invested in a diversified portfolio. Here's how it grows over time. Here's what's happening to it. But you're not showing them all of your wealth. They're not seeing anything but what's in the donor advised fund, right? So I really like it for that tool. It can be a really fun vehicle for bringing a family together for charitable giving, okay? And teaching kids good rules, right? Good rules for living, good, you know, we want to give back. Okay. All right. And I think this is actually the last slide that I have. So if you think of your questions, you know, I definitely want to hear them. But it's this idea that when you turn 70 and a half, and I know some people, when I say 70 and a half, they're like, no, it's not 70 and a half anymore. They changed the Secure Act. And yeah, that's required distributions. And I'm sure that they just love keeping people like me employed. Because when they made the law change on the required distribution age, they forgot to change the age on what I'm about to talk about, which used to be synced. They used to both be 70 and a half, but they changed when you have to take this, just to slow down. You have to start taking money out of an IRA when you turn 73. The year you turn 73, and sometimes people say, well, whoa, no, it's not that year though, isn't Joel? Because don't you have till April 1st of the following year? Yes. You have till April 1st of the following year in your first year. And I will tell you, I never want any of you to do that. Well, it's very narrow sleeve. In almost no circumstances do I want you to do that. Why? Because if you don't take your required distribution this year and you take it April 1st of the following year, you also have to take a required distribution in that year. And so now you have to give 2 years of required distributions in one tax year, and you can bump yourself up into a higher tax bracket, and it can be a big mess. So I always just say, no, when you turn 73, that's the year you have to start giving. However, when you turn 70 and a half, about a dozen or 15 years ago or so, they created this idea of the qualified charitable distribution, a QCD. And the idea is you may give from your IRA directly to a charity, and you don't pay income taxes. You just took money out of your traditional IRA, a vehicle that anytime you took money out, you had to pay income taxes. And you've given it a non-taxable off-ramp. Now, why is this so valuable? This became especially valuable when the Tax Cuts and Jobs Act came out. Because again, prior to the Tax Cuts and Jobs Act, most people were already itemizing and they were getting help from their charitable giving. So I would look at things and I'd say, well, they could do a QCD, or they could just give cash to their, take out money out of their IRA and give cash to the charity. And it's kind of the same thing, isn't it? And it kind of was. But in a world where you don't have a mortgage, you don't have enough medical expenses, and all you got is your $10,000 in state local tax, and it's a $20,000 hurdle to get to where any charitable giving is helping you, you're getting help from $1 when you give via QCD. Every dollar you give is saving you income taxes because you're taking money out of a tax deferred vehicle and avoiding tax altogether on it. So up to $108,000 per year this year, you can do that per year if you have a super large IRA. And the additional benefit when you turn 73 that is added, it makes it even better than when you were 70.5, is that you can count qualified charitable distributions toward your required minimum distribution for the year. So if I turn 73, I have to take $40,000 out of my IRA this year, but I give $10,000 to charity via QCD. I now only have to take out $30,000. And so it's in essence, an above the line deduction on my tax return, which is the best kind, right? It reduces my adjusted gross income. I love that. That's perfect, right? So QCDs are a great strategy once you get into your 70s. This is not something that you can use prior to turning 70.5. And it's actually not even the year you turn 70.5. You have to actually be 70.5 to do this. So don't do it like at 70 in 3 months, because it doesn't work. The other thing that is a huge red flag that I need to tell people when they do QCDs is there is no tracking of this anywhere on the custodian side. So when you get your 1099 at the end of the year from Schwab or Fidelity or Morgan Stanley or Merrill Lynch or wherever, it's going to say you took out this amount from your IRA, and you did, but you gave it to charity. And so when you send all your tax documents to your tax preparer, you need to tell your tax preparer, this is how much I did in QCDs. Because otherwise it's all going to be added as taxable income. There's no spot on the tax form that indicates a portion of it was charitable. I really wish they'd make that adjustment, but they haven't.
Can you describe the process for actually executing this?
For doing this strategy? So the question is, how would I go about implementing this strategy? And the way you do it, if you have an advisor, you just call your advisor and they know what they're doing. If you do not have an advisor, then you call your custodian that you're with, you know, Vanguard, Schwab, Fidelity, whoever it is, you call them, you know, whoever holds the IRA, and you say, I'd like to make a qualified charitable distribution. And then they will just tell you the process. And it's generally pretty straightforward. They need to know the employer ID number of the charity you're giving to. They need to know the name of it and the address. If you have those 3 pieces of information, they're going to be able to find the charity. The only other thing that you need to know, well, 2 other things. One is, do you want the check to come to you so that you can give it to the charity? Or do you want a check to go straight to the charity? You can do either, no problem. But you have to choose one or the other. And then you have to know whether the charity has any rules for what they want you to include in the memo field when you make the gift. Right, because you can, there is a memo line, just like any check, where you can indicate, you know, further information about where it's to go to. But that's the other thing to know. All right, so it's a pretty straightforward process. The hardest part is just remembering that you've done it and telling your tax preparer, or if you self-prepare, just remembering yourself. Because sometimes I'll have a client, I'll say, look, I'm owing $10,000 in taxes, and I don't know why, because I thought we did a tax planning exercise and you told me I was gonna, and I say, did you tell TurboTax that you did a QCD this year? I said, oh, where do I do that? And you just look up, you know, qualified charitable distribution, TurboTax, you can find it that way, but you can also just go through TurboTax's questionnaire. Generally, you've skipped over something in TurboTax's questionnaire that said, did you give a qualified charitable distribution? And you were just so fixated on doing no, let's get through this, that you missed something that said you were actually supposed to do that. Okay, so that's the number one way people don't save money on this strategy, is they forget when they do their taxes that they did it. Okay.
I have a
Yes.
question. If you're in this category, and given what's happening in the market now, and everyone's IRA is generally not doing well.
Yep.
And we don't really know what's going to happen, because the reason for this dip is unprecedented. Does it make sense to do this, or to hold on to whatever in your IRA in the hopes that it will go up again?
Yeah.
If you have assets that you can give just by writing a check?
Good question. So the question is, if given what's happening right now, is there a better time to do or not do this strategy? And the answer I give is, the ideal time to implement this strategy would be the day of the year that the market is at its highest. And the rationale is, you've now given the smallest percentage of your IRA to the charity, you know, that you could have done.
Mhm.
In practicality, if any of you can tell me the highest day of the market for the year, I have a job for you. We're gonna go out and start a business and make a ton of money. We don't know that, and so what I'll tend to do is just say, let's just, you know, do it at a time that makes sense to you.
Mhm.
And if you're just agnostic about it, you're saying, well, I don't know yet, and I think that we might be in for turbulent times, then I said, just do it now. And if you're saying, no, I don't know, I think markets might be higher later in the year, and I say, well, then let's talk in September.
Mhm.
The other thing I'll sometimes say is like, let's hedge. Like, so I had a client this morning where I was talking about Roth conversions, and the Roth conversion is the exact opposite. You want to do the Roth conversion on the day that the markets are lowest for the year. And I was like, well, I don't know. I mean, markets could go much lower. And so what we decided on was doing half,
Mhm.
right? Just let's hedge and do half of it now, and then we'll talk later in the year. And that can be a strategy that kind of feels good too. To just say, all right, well, markets are still somewhat reasonable place. I mean, depending, if you were an all tech investor, then this doesn't apply to you. But for most of us, it feels a lot worse than it actually is so far.
Mhm.
And it's still a reasonable time to be making
Mhm.
donations, right? But if you're concerned about where things might head during the year, do it now.
Right.
That would be the thought.
To do it now, or to write a check.
Or write it, yeah,
Write a check.
you write a check, absolutely. The issue is like, if you're writing a check and you're at an age where you could have gotten the qualified charitable distribution,
Mhm.
then generally the check is not gonna help you at all in your taxes, and the qualified charitable distribution would. And so markets would have to drop 30%
Wow.
generally for that check to have been better to do than the
Uh-huh.
charitable distribution. The other thing is, keep in mind, like if you have an IRA and you've got some bonds and some stock in the IRA together, and you sell some bonds to do the gift,
Mhm.
right? Or rather, said differently, you sell just the stocks to make the gift. You haven't changed your overall allocation, right?
Right.
Like that's the same thing applies to charitable giving that would apply to distributions in retirement, right? We want to draw from the thing that is high and not draw from the thing that is low. And that's a way to avoid really being hurt too much by giving when your IRA's gone way down. If you're just giving from the defensive side, it didn't really cost you anything. You're just letting the stocks do their thing, and you'll go back to using them later on
Okay.
when markets go back up.
When you're 73.5.
Yeah. At that point, it's helping you no matter what, right? If you're 73, you were gonna have to give money from it at some point during the year anyway, might as well do it. Yeah. Okay. That was what I wanted to cover. I think that I've got some, let's see here. I've got to throw disclosures up just for a second at the end, but that's it. Okay? So,
You need to check something.
yeah, have to check a box. That's all compliance. I put the disclosures up there. So, yeah, I mean, the idea here is that there's many ways to do charitable giving, many more than you generally think of at first. And everyone's situation is different. And so it's a really good idea to just kind of consider your own situation. Maybe talk with somebody who knows what they're talking about, and using these different tools in the toolbox to get an idea of like, well, what's best for me? And I'm always happy to do that for Friends of Washington English Center. So anybody who wants to chat with me about that, about what would be the best way to give to WEC, schedule 15 minutes with me, we'll talk about it. Okay.
How do we get a hold of you?
Oh, how do you get a hold of me? You can use my with Savant Wealth Management. I've got a profile there that you can just click on my email, but my email is jkundick, CUNDICK @savantwealth.com. Or my phone number is 703-288-0500. Welcome to reach out and ask me, your questions that you didn't feel comfortable talking about in the group session. Okay?
Are there any questions online though? Quiet group tonight.
All right. Well, good to be with you all. Thank you.
Thank
for your
you.
time. Like, let's.
Thank you.